welcome all. This could be one of the most interesting and maybe the ambitious target of the government of India when it was announced. The government talked about a year and a half back around the $5 trillion economy by say financial year 25. Now, for last 2 years, a lot has happened. We all know what has happened in the world, and all those calculations would have gone for a toss because the last 2 years, it's almost like a declining phase. But still, we are hearing that the timelines as well as the $5 trillion economy stands. Now, to start with Dr. Ghosh, just from an understanding point of view, what's your view when it's about this target of $5 trillion? Firstly, when we are very sure this will be achieved, but around the timelines, what sort of growth are we talking about? And according to you, is it achievable during those timelines?
Yeah, thank you, and thank you for giving me this opportunity to speak on this platform. See, this 5 trillion number when it was announced, and I think I remember in 2019 and before the pandemic start, actually we are entrusted with preparing also a roadmap from our bank on how we can do actually this 5 trillion economy and what are the reforms which could happen for a bank like us and what we can suggest which could start from the branches. So I still remember those days where we have prepared host of papers to understand where do we stand now, what could be the CAGR, all those things. But leaving aside that, I think at that point of time also, to me, if you ask me, 5 trillion was just a number and an aspiration. Because I think we had actually, and if I remember correctly, I think we had drawn a roadmap of India for the last 60, 70 years. We actually saw that the growth in the last 10 to 20 years, actually 20 years, when the incrementally India has grown significantly, which was not there in the first 53 to 54 years. So, but the important point to note, again, I emphasize over here is, as of now, I think maybe 5 trillion will be achieved, if not today, maybe 2 years or 3 years down the line. But as of now, the immediate priority is that while that benchmark is credible in the sense that we aspect to become a 5 trillion economy at some point of time. But as of today, I think the primary job is to get back onto a roadmap of at least a growth trajectory, which was in the before the years of 2018. So that should be our first objective right now. Of course, the 5 trillion will happen at some point of time. And if we have time, we can discuss some of the priorities which you need to do. But to me, as of now, I think maybe it should be better if we concentrate on building up our growth rate to a sustainable basis before you can start thinking of again moving in that direction.
Thanks, Dr. Ghosh, for that background. Now, staying on the same topic, because this is getting interesting that way. Staying on that same topic, to Dr. Baig means, as Dr. Ghosh is pointing out, that it's going to happen. It's about the timelines. Now, the other part which Dr. Ghosh talked about was that the roadmap to it and the reforms needed to do that. So according to you, because you have looked at a lot of economies, according to you, what are the sort of reforms needed which we need to do to get to that $5 trillion?
Thank you very much. Let me put the numbers in context first and foremost. What does 5 trillion mean, and what does 5 trillion in 2030 mean? It means between now and 2030, dollar GDP growing by about 7% every year. Dollar GDP, right? So the rupee has to be stable, and in nominal expansion has to be 7%. So let's say 4% real growth, 3% inflation, or 5% real growth, 2% inflation, some combination of that, which does not seem impossible to attain. But that's 2030, okay, not 2025. 2025, I think we can just put aside, it's not going to happen. But more importantly, what does it mean for the average Indian? Today, the average Indian's per capita GDP income is about $2,100, which is even not the highest in South Asia, forget about Southeast Asia and so on. If we grow that by about 7% for the next 10 years, And the population grows from 1.3 billion now to about 1.41 billion, which is the United Nations population forecast. So India will end the decade with a per capita GDP of about 3,800 US dollars, which is lower than what Indonesia is today. So 5 trillion seems like a very big, impressive number. For the average Indian, it will not be impressive at all. Goals, ambition has to be far bigger than that. And again, the setback of COVID-19 notwithstanding, to me, the scale of India is so big and the demands of the population is so much and the starting point is so low that 5 trillion is not an impressive target whatsoever. If it was something that was going to be achieved by 2025, one thing, that's not going to happen, but it cannot be a 2030 target. Something has to be done faster than that. So that's the first and foremost, that, the numbers look very big, very impressive when we say 5 trillion, but on a per capita basis, India's per capita would be lower than today's Indonesian per capita income in 2030, even with a $5 trillion economy. How do we get there? The history of development is pretty straightforward. You promote, and may I ask somebody who's on the call to mute their phone, so because I'm picking up some feedback. Thank you. The history of development is very straightforward, that you have an economy that could be largely agrarian. People go from, may I please request whoever has their phone on to mute it? Thank you. Now I still am picking up the feedback. Anyway, I'll keep talking. What you need is people to migrate from the agriculture sector to the industrial sector, from the rural to the urban area, or you make the urban area so well endowed in infrastructure, in human capital, that the migration is not necessary, but people can still have high productivity activities and push up the value added in the economy on a sustained basis. Now, again, if you look at the last half a century or 60 years of development track record, it's only countries that have done the rural-urban migration, agriculture to manufacturing transition, that they seem to have pulled it off very, very well. And I basically have East Asia in mind and some degree of North Asia. To do that, we have to turn around the really worrisome trajectory with respect to manufacturing value added in the history of India. Over the last decade, India is one of the very few countries in Asia where manufacturing value added as a share of GDP has declined. China is the other one, but China is at a whole different level. They started the decade 2010 at 36, 37% manufacturing value added to GDP. They're about 31 now. They're going through their growth recalibration and moving toward a consumption-based economy. So that's a whole different story. But beyond that, when you look at ASEAN countries, when you look at a country like Vietnam, for example, manufacturing share of GDP has gone up by 300 basis points or 3% from the low teens to mid-teens. You can think about neighboring Bangladesh, where again, manufacturing GDP has gone up by about 300-400 basis points. India has regressed. It used to be mid-teens, it's in the low teens now. And we have to basically recognize the fact that it is by itself is not a sufficient statistic to understand what is needed, what reform is needed. It needs to be seen in the context of what's happening in the service sector. India has a very dynamic, highly productive service sector. And the pace with which the service sector is expanding is lapping the pace with which the manufacturing sector is expanding. In itself, not a bad thing. If you have highly productive service-oriented activities, you may very well leapfrog the need from agriculture to manufacturing. You just go from manufacturing, agriculture straight to services. And many prominent economists who focus on India have talked about the possibility of that paradigm happening in the context of India, that India doesn't have to follow the old school East Asian paradigm of going from agriculture to manufacturing to services. India can just do it in one jump. The way with which we have technologies around the world these days, maybe that's the way to do it. But it remains an issue, which is if you want the per capita income of the average Indian to increase, there is a certain critical mass of population that must have manufacturing employment. Manufacturing employment is stable, assuming this industry is stable. It gives people a purpose. Even those with relatively low skill can do some degree of manufacturing, not the frontier end, but some of the low end. And any society out there would have a large segment of population who are not highly educated, who do not have the wherewithal to join the knowledge economy or being at the frontier. For them, having a manufacturing base that can absorb them is critically important. Consider Singapore, where I live. This country should be now like Hong Kong, 2% manufacturing value added and 98% services value added, because Singapore is immensely wealthy, has leapfrogged all sort of frontiers of development, and has very high-end human capital. But that's not the case. Government of Singapore has pursued industrial policy over the last 3 decades to ensure that manufacturing GDP as a value added remain a significant part of Singapore's economy. See, even today, as I speak, Singapore has Shimang, which is a bicycle producing plant, producing high-end bicycles in Singapore. Rolls-Royce in Singapore, they manufacture chip manufacturing plants in Singapore. You could argue a country with a $60,000 per capita GDP should not be sending their workers to 9-to-5 manufacturing jobs. That's not, they should be doing cool work for Amazon or some knowledge economy stuff. But that is not the case. The paradigm followed by a country like Singapore has been, we have to have a manufacturing base regardless of what our comparative advantage is. It may very well be that some of the things need not be produced in Singapore and that goes away slowly out of Singapore. But some basic manufacturing needs to be there because that is a very good conduit for absorbing relatively lower scale population into fairly high scale, highly paid jobs. So I think, and I'm going to stop right there, just to answer your broad question, just to end up with this point, that what is needed over the next decade is a recognition that 5 trillion is not a sufficiently ambitious target, that on a per capita GDP basis, India needs to go toward middle income over the next 10 to 15 years. That would require a more ambitious target. And this trend that we've seen over the last decade where manufacturing share of value added has been declining needs to be reversed and hopefully re-energized, Make in India policy, the various supply chain diversification impetus that we're seeing around the world, which India, hopefully part of the story, will address that.
Sure, sir. So you're a global economist. So how do you see India being compared to some of the other emerging economies like Indonesia or Bangladesh or Vietnam? How do you see India?
So there is no question that global investors have enormous goodwill toward India. Look at the foreign institutional flows and foreign direct investment into India over the last 3 years, even before COVID, when growth was slowing sharply, when the financial sector was going through a tremendous amount of stress, and there have been several major policy-induced contractionary impact on the economy, starting from demonetization to GST, which in the short term was highly disruptive. Investors took all of those measures, all of those setbacks in strides and have remained long India. And even in the last year and a half, when India has delivered virtually nothing to note in terms of macroeconomic performance, we have seen relentless flows. So from the perspective of global investors, a large aspiring economy, which is a democracy, which is has a favorable demographic dynamic, and is carrying out certain measures that are obviously painful in the short term, but hopefully pave the ground for long-term returns from a structural perspective, are all seen very favorably by investors. But I'll tell you another thing, that in terms of flows, while India's numbers are impressive, it is still not a patch on the numbers on China. May I share with you a couple of startling facts? Since January of last year, China has received on a net basis, combination of foreign direct investment and portfolio flows of $670 billion. Net. So China actually invests a lot outside, right? The Belt and Road strategy and so on. China also invests portfolio outside. But it's a net basis, China has received $670 billion in the last 1.5 years. And the macroeconomic management of that, consider the contrast with India, where India has received flows. RBI has had to intervene very heavily and now has over $600 billion in reserves, which has blessings, but also some macroeconomic management issues, cost of sterilization, impact on domestic prices, and so on. In the case of China, that $670 billion inflow has been associated with virtually no change in reserves, very little pickup in money supply from trend, and virtually no major appreciation of the exchange rate. How on earth is China pulling off this magic trick where trillions of dollars come in on a gross basis and 700 billion comes in on a net basis, and the macroeconomic management seems very, very day-to-day, no big deal? It's because China has figured out a way to recycle the money. The Chinese banks are becoming major players in the world of trade finance. They hold huge amount of foreign currency deposits. They're a huge lender in the global marketplace. As a result, even though the money comes in and there are questions about the hot money creating macroeconomic distortion, it is recycled in a very orderly manner. And as a result, China's claims in the rest of the world goes up the moment the world starts increasing its claim on China. So I give this example as a contrast to the absolute story of India, which is great, that global investors are favorably predisposed toward in India. There is a strong FDI flow, FII flow, but it is only impressive by India's historical standards. It is still not impressive by China's standards.
So, see, moving on to the $25 is ambitious target, but to achieve that, one of the things which is needed is private capex and the government capex both to go up significantly. And what we have seen over time is that actually private capex is coming down quite a lot. So, Samiran, to start with you. So, firstly, what do you think? How can we restart this entire private capex? And how do we, and what needs to be done so that people get that comfort, because today there is very little comfort in creating anything new.
Yeah, thanks everyone for having me here. And before I directly answer your question, let me put my 2 bits on the 5 trillion number, because it's always tempting to talk about the 5 trillion number, however cynical you want to be. So Taimur has put a 10-year target on the 5 trillion. Let me put an optimistic 5-year target, and let's rework the numbers with the optimistic 5-year target. So broadly speaking, we have a rule of thumb that anything which grows at 7% doubles in 10 years. So we are now at about 2.5 trillion. So if we grow at 7%, then we go to 5 trillion in 10 years. So I'm just using that same rule of thumb to say that if we grow at 14%, then we will probably double in 5 years. And then let's look at how do we grow at 14%. So there are 3 components to this. So we can very easily take the easy way out and say that, look, let inflate the economy, let inflation be 8%, and it will be very easy to achieve 14% growth, because the other 2 components are real GDP and exchange rate. So if you have little bit exchange rate appreciation, 2-3%, 8% inflation, then even with 3-4% real GDP growth, we are going to get 14% total GDP growth. But we don't want that sort of growth, right? We want an economy where the real GDP growth is the bulk of this 14% number. So let's say, since we are in the game of being optimistic, so let's say we optimistic can say, what do we put the real GDP growth number at 8%, and then put a 4% on inflation and a 2% exchange rate appreciation, which is in some sense best of all the worlds that you can be in. And then look at what do we need to get the 8% real GDP growth. So we looked at about 25 countries' last 70 years of economic history to find out whoever achieved 8% GDP growth over this period, what did they do correctly to get 8% GDP growth? And the result that we came out with is that if a country grows their investment at 10%, and if they grow their productivity at 3%, then with more than 90% probability, you are going to end up with an 8% plus GDP growth. So the target for India is very clear, that if we want to double to $5 trillion economy in a desirable format of having 8% GDP growth, 4% inflation, and 2% exchange rate appreciation, then we need to grow our investments at 10%, and we need to grow our productivity at 3%. And to grow our investment at 10%, we just can't depend on public investment. The private capex cycle has to start. And to grow productivity at 3%, and by the way, in India's independent history, there has been only a brief 5-year period when we were anywhere close to even 3% productivity growth. So the productivity growth does not come naturally to us. So there you require all the reforms, and I'm sure we will get a chance to discuss them in greater detail during the rest of our conversation. But the reforms part is needed to get the 3% productivity growth. And for the investment cycle, I'm turning a bit optimistic on private capex. In fact, if the second COVID wave was not there, I could have been sticking out my neck and say that it's possible to start in 2021 itself. But the second wave probably has pushed it back to 2022. But if you look at it from a macro standpoint, all the preconditions for private capex are finally falling in place. You have low interest rates, you have very good liquidity in the financial system. So the financial side of supporting the capex is in place. If you look at the balance sheet, the companies have deleveraged significantly. The profitability of companies have increased substantially. And in India's last 25 years of history, if you do some sort of analytical exercise, you will figure out that this profitability and private investment go hand in hand. So both the profitability and deleveraging from a balance sheet side is going to help this private capex. And on top of it, you have this support from the government through PLI schemes, and hopefully they will come out with some schemes for the export sector as well. So once you get all these things in place, the only missing piece in the puzzle is the capacity utilization rate. At this moment, because of the second wave, we have probably dropped even below 60% on capacity utilization. That number needs to increase up to about 75% or so before someone actually gets convinced about putting capex. So that process, in our view, is going to take a few quarters before we reach that point. Once you reach that 75%, maybe that's where the next phase of capex starts. And on that optimistic note, if we can get a 10% plus private capex growth, who knows? We can hit the 8% GDP growth too, and we can support Taimur's basic point about getting everyone employed productively. That's possible only if you have this sort of a private capex growth over the next few years.
Thanks, Samiran. And keeping on the same point, because there are some really interesting things I picked up. One was that Dr. Baig talking about that why to get satisfied with 5 trillion. It's not going to be enough for Indians. And Samiran talking about that actually we need private capex to do it. So Nikhil, coming to you, see, we definitely all of us know that we need private capex. We need the 5 trillion economy. Now, in your view, because we are talking about private capex, maybe I think I've read a lot of notes from 2014 to 2021 now that private capex is coming, but somehow it has not come. Now, it seems like that the stars are aligned. So according to you, what needs to be done? What needs to be done to get that private capex to restart in India?
Right. Thank you for the opportunity. Okay, so I'll take a step back to your point, which you mentioned that from 2014 to 2020, we have read a lot of notes. We have seen a lot of optimism. Still, in 2021, we are still considering, or we are still wondering whether we will get the capex growth that is required to get faster GDP growth or not. Santosh, if we look at India's investments, it's actually a little bit different from a lot of other countries. So we all know that when we say private capex, it's just implicit that when we talk about private capex, we assume it to be corporate capex. That is actually not the case in India. Private capex in India is a large portion of private capex is actually done by households in India. So if we look at total investments in the country, only about 50% of investments are done by the corporate sector. As much as 35% or more than 1/3 is actually done by the household sector, which is what we call the real estate. So household investments is almost purely in the real estate or construction sector. And the remaining 15% is done by center and states together. So what has happened, if you look at 2014 to 2017, you will see that while corporate capex was very weak in the initial years, that was FY15, FY16, and the first half of FY17, household capex almost collapsed during that period. And I'm talking of the period before demonetization, right? So prior to demonetization, corporate was weak and household capex was also weak. But if we move to FY17 second half, FY18, FY19, you will see that while corporate capex picked up, by which I mean if you look at BSE 500, for which we have extremely regular data, you will see that their nominal capex growth was close to 10% or so during the 3-year period, FY 17, 18, 19. The household capex, on the other hand, was in very low single digits. So one of the key reasons why this private capex or India's total investments not picked up, it is not because of the government capex. We know government has been pushing its capex. Eventually, center governments account for only 6% of capex and center and states combined account for only 15%. It is not that the government has lagged. It is not that the corporate has lagged significantly. It is the remaining 1/3 or household capex, which has been the biggest drag. Now, of course, if I compare investments vis-a-vis investment in mid-2000s, when even corporate capex was 25 to 30% CAGR, that is totally understandable. That yes, if you compare recent decade with the first decade of 21st century, investments were low everywhere. The growth was low everywhere. But if I just compare within this period, which sector was contributing more and which sector was a key drag of lower capex growth, I believe, or my understanding is that it's the household sector, it's the real estate sector or the construction sector, which is at the middle of the entire slowdown in India's investments and thus GDP growth that we have seen in the last 6 to 7 years, even prior to COVID. And that is why the question is now going forward, as Samiran rightly pointed out, that right, we have to have higher capex. That is the right way to move forward. In fact, that is the only way most of the East Asian economies have successfully transitioned from low income to high income countries or high middle income countries. The point is, as Samiran mentioned, we have low interest rates. We have a lot of government incentives. The capacity utilization is very low. But I think the missing part where we need a lot of work still, and which seems to be something which has to happen somewhere on its own, is the demand in the country. Right. So the monetary policy is providing full support to the investors, not only the financial investors, but the real companies or the participants who invest in GFCF and inventories. The fiscal, the government is trying its best to facilitate. The question is there enough demand for the corporate sector to feel confident that they go ahead and start announcing new capacity or new investments? That will happen again. Samiran kind of pointed out, he mentioned that when the capacity utilization reaches 75 to 78%, again, we are talking about only manufacturing capacity. Manufacturing is only one part of the entire investments in the country. But that demand is something that we need to keep a very careful eye on. That is something which is lagging, I guess, despite all the things that are in place. So from the supply factor, from the supply side, a lot of things have happened, are happening, and probably will remain in place for the next couple of years. The question is, till the time these supply positives remain in place, will demand also be there to create this a virtuous cycle of capex and GDP growth? So that is, I think, we need to be very watchful.
Sure, Nikhil. My next question is to Dr. Ghosh. Sir, private capex will only pick up in case banks lend much more money. So there's a general apprehension that banks are parking 4-5 lakh crore in the reverse repo window. So what is needed to revive the animal spirit in the banking system, sir?
I'll just give you, I'll give you 1 minute. I think what Taimur said and Samiran said in terms of the 5 trillion economy, just I'll give you some specific numbers because I will answer that question from that perspective. If you actually look into the experience of South Korea and China, in South Korea was in the same situation in 1970 India was there, and then China also was in the same position as India's data was in 2000. And after that, they have seen a sustained period of 10 years of growth, 10% growth. So that's the first thing that we need to do, at least grow at double digit for the next period of 10 years. Now, this 10-year puzzle of 5 trillion economy, I think India's is now currently around 2.6 trillion economy, 2.5 to 2.6, depending what could be the GDP number at the end of year. The first trillion, we did it in 57 years. We became an first 1 trillion economy in 57 years. Second trillion, we became in 7 years. And the third trillion, we are supposed to do it in 5 years. then 4 in 3, and 5 in 2. But unfortunately, because of the COVID, I think third trillion, which is supposed to happen in 5 years, possibly it could extend it by 2 years more. So if you do a rough calculation, that could actually take you an period towards beyond 2030 than what you were earlier expecting. And finally, and this is basically the most important point, is that if you compare two countries, China and India, and this will actually answer the question of the bank credit also, is that what happens in China and India. I think if you look into the share of the larger funds in terms of the market capitalization, both of them are doing similar last 4 to 5 years back. But unfortunately, because of this period of corporate deleveraging, corporate stress, that larger firms in India's share has now significantly declined in the last 1 or 2 years, which is a basic component of higher growth if we want to achieve that. So that's the first point. Now, regarding the specific point of this bank credit, when this needs to pick up, I think you need to understand that the last 2 years, how it has evolved. If I give you some numbers in this context, I think in last year, the total corporate deleveraging was around 2.09 lakh crores. So what has been happening is that the banking sector is flush with funds. However, given the low interest rate scenario, which has been now for the last 2 years, the large number of the blue chip corporates are actually taking the bond market. If you look into the data of the bond market, the total amount of resource flow to the commercial sector, if you look into this data, and if you compare that with the bank credit, last year the bank, I think the total corporate number actually this from the bond market grew at around 9% last year, compared to when bank credit goes up around 5%. So what has been happening is that the significant amount of deleveraging, this low interest structure has driven away a lot of corporates to the bond market, and they have been successfully replacing the high cost bonds with the high cost bank credit with the low cost bank credit. And given the fact that we now have a system of external benchmarking, there has been companies have also been borrowing at rates which are closer to the repo rate with a markup. Now, whether that could result in some sort of an financial stability problem 2 to 3 years down the line, that's a matter of debate. But until and unless the central bank doesn't reverse the accommodative policy, or in the sense that this corporate deleveraging continues given the low interest structure, I think it will be difficult for the bank credit to pick up in a meaningful way. And finally, I think at the end of the day, if you look into the data, last year we degrew by minus 7.3%, and the bank credit growth was 5%. So if you want to have a one-to-one relationship, the way we used to have earlier, that if the nominal GDP grows by 12%, bank credit will go by 12%, that sort of formalization is broken down given the advent of other sources of corporate funding from the other markets. So if I take all these factors into account, I don't see that, and it's good for the economy that the reliance of this bank credit is actually declined, because the more you have equity participation, the more the promoters get in money, the more is equity participation. That will be better for markets in terms of better pricing discovery. So in my sense, I think we will not see a credit growth rate which will be in double digits maybe this year, maybe even next year, but that will not anyway constrain the growth revival which we are anticipating in the short to medium term.
Sure, sir.
Thanks, Dr. Ghosh. And moving on to the other part of it, of this $5 trillion economy, and then the capex which we think about. In the recent budget, right, the government talked about investments, and they have been a little bit liberal with their fiscal roadmap. Now, Samiran, for you, means how this liberal, firstly, ambitious, this liberal roadmap as well. If we want to sort of if you want to grow that fast, and then if you want to, you think about it. If the government were to sort of being too liberal on their fiscal, how would, as an economist, you think about it?
Look, let's face it that as economic students, what we were taught in our textbooks versus how economics is being played out today, they're very different things altogether. So some of the orthodoxy we probably need to shed before we jump into any kind of policy conclusions today. And there, the issue that we generally have is that we have followed certain yardsticks for fiscal in the past. We have said that fiscal deficit to GDP in India should be 3% at the central government level, including state governments, maybe 5-6%. And then we have said that the debt to GDP ratio should be 60%. It's a very open debate that where did we get these numbers from? Almost it feels like they were uh, mm, based on very loose calculations, if not plucked out of thin air. And what's happening today is that we are having a almost complete relook at all these numbers, right? Our debt to GDP has already crossed 90%, and no one seems to be too bothered about it, right? If pre-COVID, if anyone would have even suggested 70% debt to GDP ratio, he would have been banished from the economics group, any economics group. Now, the point I'm trying to make here is that the way to think about fiscal today is to think that whether the economy needs a demand support. If the answer to that is yes, then the second question is how can we provide it? It is not a question about how do we finance. I think there are enough and more ways of financing that fiscal. And I think in the second question about how do we give that demand is where you have to be innovative. And my sense is what has happened over in the post-COVID period is that we have just utilized the existing schemes and just bumped up our allocation in those existing schemes to give certain kind of fiscal support. And obviously, through that, the fiscal impulse that you create is relatively minimal. We haven't really experimented with fiscal. There is a huge amount of data that is available today. And if we're willing to use that data, we can design extremely directed, targeted fiscal impulse where every money spent will be usefully spent. So let me give you just a couple of examples of what I have in mind. We now have the entire GST data set, right? So we would be at this moment absolutely accurately able to say which are the establishments which have seen the maximum shock from COVID, because their GST data will show it up. So you can have a targeted stimulus program for those establishments which have got this shock. Similarly, you have this EPFO database. You can use the EPFO database to figure out which are the people who have lost their jobs in the formal sector. And if you want to do a direct cash transfer into the bank accounts of those people, you can very easily do it. So the point I'm trying to make here is that if broadly we agree that the economy is suffering from a demand side issue. Now, the challenge often we face on a lighter note is that because we talk so much about our demographic dividend, young population, 1.4 billion people, that we take demand for granted. That we don't have to think about the demand side of the economy. It's just a matter of time, it will just come back automatically. So we focus our entire energy, policy, energy, everything onto the supply side of the economy. But I think if we take a step back and decide that this is a once in a century pandemic which has affected the demand side as well, then the next step would be to just simply design a better fiscal response to that demand problem not being bothered so much about whether the fiscal deficit is 6.5% of GDP or 7.5% of GDP. I don't think in the bigger scheme of things that will matter in a big way.
Sure, Samiran. Thank you so much. Coming to Taimur, as Samiran mentioned that pre-COVID, everyone was afraid that rating agencies might downgrade India, but suddenly no one is talking about that. So in your view, what do you think is the tolerance level of a rating agency and how are they looking at India?
I think the ratings agency analysts are in exactly the same shoes that Samiran is in, as he just pointed out, that the way we have looked at debt GDP ratios and thresholds for fragility have all been turned upside down with the structural decline in interest rates around the world and huge amount of money expansion, not causing huge amount of inflation, and therefore the disciplining mechanism that used to come from theories of fiscal dominance, theories of debt deflation, all those things have sort of been turned upside down. I don't think the basic laws of economics, just like the basic law of gravity, have been turned upside down by COVID-19. I think we are at an extraordinary stage where a massive amount of liquidity injection is doing exactly what it did in Japan in the early part of the century, which is the central bank goes out, buys bonds, injects cash, and that cash then comes back to the central bank as a deposit or goes to the government bond market. This can turn on a dime very, very quickly if the US government were to raise interest rates. And all that, stability in the global market would then come to a crashing halt. And if you think about the last 40 years, every single global crisis more or less has been precipitated by a US rate tightening cycle. So yes, I concede the point that at this juncture, issues related to debt GDP, issues related to the fiscal deficit will not bother global markets, nor would cause rating agencies to come up with downgrades. But let's scan the horizon. Where have we seen downgrades in the last 6 to 9 months? Countries that have shown a very poor track record of managing the pandemic, which has then spilled over to major scarring of the economy that has caused exchange rates to depreciate, capital flows to turn volatile, and the country then becoming mired in this vicious cycle of outflows causing depreciation pressure, which then causing more outflows. India, thankfully, is not at all in that camp. The fragile five that existed during the taper tantrum 8 years ago, India was part of that. India is no longer that, thanks to the massive increase in reserve accumulation, as well as the improvement, if you will, or decline in the external imbalances that India used to have 7-8 years ago. So I think from a ratings perspective, if you go mechanically, which is, how is your external funding environment? Is there a macroeconomic mismanagement taking place domestically? Then India, I think, is fine, because I think we can say on both ends, India is okay for the time being. I have been, sort of seen this sort of arguments that people like Larry Summers and Jason Furman at Harvard have been making, which is that debt GDP itself is a flawed concept because it mixes up stocks and flow. Debt is a stock concept. GDP is an annual flow of value added in an economy. That maybe we need to think beyond this and think about interest rate expenditure as a share of the net present value of GDP. So the world of economics itself is rethinking some of these measures. And I'm sure sooner or later, the IMF in its debt sustainability analysis will make some tweaks. Rating agencies will absorb that. And the sort of things that Samiran was talking about, the 3% of revenue deficit target that FRBM had, those things will probably get revised at some point as well.
Sure, sir.
So I think the interesting point is today the economists are willing to sort of be understanding on a higher fiscal side. So seems like the rating agencies. So Nikhil, what about the bond market? How would you think the bond market would react if we go slightly away from the fiscal tightening?
Of course, the bond market would not be very happy if the supply increases fast, but I'm sure if the government decides to expand fiscal deficit, there has to be a good reason for this, and the bond market will be considering factors that is leading to. Yes, so I was saying that if the fiscal deficit expansion happens and there is more supply of bonds, then I'm sure the government will be explaining us the reason for the expansion in fiscal deficit. if it is expected to lead to a better GDP growth or economic activity or the demand push that I was talking about earlier, then of course the bond market would be willing to address, or would be willing to take this higher supply of bonds as well, because that is eventually leading to better growth, and it is expected to lead to the virtuous cycle that we have been talking about. So it all depends on not only what you do now, but of course the medium term target or the medium term path that the government comes up with to explain why whatever you are doing is not going to create any uncertainty or dangerous path over a period of time. So if they're able to do that, then well and good. You can definitely go ahead, and you can also expand your fiscal deficit. Without a clear medium-term consolidation path, or a path where you show that things are not going to go out of control, I don't think they should even attempt of thinking of expansion in fiscal deficit.
Can I just come for a second?
Sure, sir.
Yeah, actually, Taimur's argument of new economic thinking, I am tempted to say two things. First is that I think basically by that logic, I think the relationship between interest rate and fiscal deficit actually is a little bit preposterous, because one is calculated on an outstanding, the other is actually flow. And the other relationship which we have all learned in economics of wage price growth and inflation, that actually has broken down in the last 10 to 15 years, because there is now no organized labor market activity. So if we actually go by that logic, maybe a lot of thinking on economic thinking may have broken down in the last 10 years. And as Samiran was saying, maybe this could be now the time for new thinking and new policy action to rejuvenate the economy.
Sure, sir. Sticking to you, sir, I mean, on the same topic as government finances, I mean, in your recent comments, you have been less bearish on the government finances. I mean, versus expectation, everyone is not too comfortable with government finances, but you've been more, I mean, you've said that it's much more manageable. Why do you say that, sir?
I think that looks into if you look into the numbers of the government finances which has come out in the last 2 to 3 months, in fact, the CGA data which is available on public domain from the 2000. So if you actually look into the tax receipt, the fiscal receipts, even the GST collections, I think all of them are quite encouraging. Just to give you a number perspective, in fact, if I just take the fuel example, this year the budgeted revenue collections from the fuel by the states and the center is at 6 lakh crores. And the way currently, even if we are assuming the consumption numbers which the PPSC has put out on its website, the total actual increase in the total excise collection could be as much as 1,30,000 crore over the budgeted estimates. And the states, if they can, and the GST collections also, if you take the last 3 months average, the total average GST number which could be higher and act to the government could be around 60,000 crore. So the center could actually, at the current rate, could mop up 1.9 lakh crores from its budgeted estimates. And if I add to that the fact that if the states do the reforms in the power sector and the urban bodies properly, the Finance Commission has specified that 67,000 crores of money can go to them. So if I put all these numbers on the table, I am bearish on the fiscal number, and I think there is enough scope for the government to do some fiscal action at this point of time, because 3 numbers are actually striking. If you go through the RBI data, the household financial savings has declined by 3.7 lakh crores over a period of April to December last year. The household debt has gone up by 7.5 lakh crores, and the private final consumption expenditure has declined by 7.4 lakh crores. So maybe now it's the best time to go for some sort of a fiscal action, because the situation right now is far different from what we had in 2008, when all those actions were actually added up to 22% of the incremental private final consumption expenditure. This year, the consumption expenditure has actually declined. So I don't think that any fiscal action will be taken negatively by the rating agencies. And there are scope for doing some amount of action at this point of time.
Sure, sir.
So, sir, see, some of the things we talked about, right? The fiscal action, when there is a room for fiscal action, they definitely, the investment At the same time, there has been one trouble in the past with India, that has been inflation. And what we are looking at today is, so the inflation has again started to move up. So on that front, see, one of the arguments we have heard about is the new economic sort of now the old economics theories don't work, or maybe inflation going up may not be a concern. So to start with Dr. Baig on this one, right? The inflation, what we are seeing is already sort of higher than what RBI was comfortable with. Do you think it is transitory, and do you think the monetary policy will get impacted because of this higher inflation?
And sir, to add to that, you made a statement that inflation is the biggest risk to equities, not COVID. Why do you say that?
When did I say that? I'm not sure. I recall saying that. You're asking me, right?
Yes.
I think I may have written about this some time ago. Okay, yeah. Now I know the context. It just came very quickly. Look, there are very different kinds of inflation manifesting around the world right now. In the US, we're seeing a reopening sort of a narrative where demand is jumping because there's been a huge amount of transfer made to the population, and they're going to run down the savings at a time when there are some COVID-related supply disruptions taking place. So that's a classic bullish inflation, if you will, that supply is temporarily tight. Demand is picking up on a structural basis because of transfers and savings boost, and therefore you're going to see most likely some degree of short-term spurt in inflation. What happens to that in the medium term with respect to expectation and further driver of inflation dynamic? I think it's a very open question. Clearly, the bond market doesn't believe that there is a long-term risk for inflation in the US, which is why bond yields are extremely low, although the short-term expectations have gone up a bit, which is why we've seen a flattening of the curve. In the case of India, clearly, it's not a bullish outcome right now with the inflation that we have seen. There's no question of a reopening of the economy causing demand upsurge that is meeting supply shortages and causing inflation. So I would characterize the current inflation dynamic in India as largely as a bad inflation dynamic. It's not a function of demand, it's a function of supply-related disruption, commodity price inflation, and some degree of indexation-related issues sort of feeding into the economy. It is very difficult for the RBI at this juncture to give any kind of hawkish signal, other than saying that they are predisposed toward maintaining a neutral stance. They might do something on the liquidity side, but they will not cut rates anymore. But beyond that, given where the economy is in the middle of fighting the pandemic, it is very, very difficult for the RBI to sort of say that my paramount concern right now is inflation. So that has to be in the back burner, regardless of how difficult it is. And I think this is where some degree of monetary fiscal coordination is important. The sort of inflation that we're seeing in India is very regressive. It hurts the poor disproportionately, and therefore there is a room for fiscal policy to act at a time when you have temporary supply disruption-led inflation, which needs to be mitigated to some extent by transfers, just like the way we saw some transfers take place last year. So to me, that's the issue. Can't really worry too much about inflation, but need to be responsive to the regressive impact of inflation, regardless of its source.
So quickly to Dr. Ghosh, given that you are so close to the banking system, right? So on this front, what's your view that how it will affect the monetary policy?
No, I think I agree with Taimur that inflation is something which we need to control, and the point is that currently inflation numbers, if you look into the 45% of the total inflation is actually being contributed by fuel and the oil. I mean, fuel and this fat and oils, this edible oils. So my sense is that at some point of time, I actually make a strong case for rationalization of tax on fuel, because given the current fiscal situation, and we cannot have a country where there is a system of GST and there is a fuel taxation structure which is different across 30 odd states in the India, including the center. And if we have to do any reform on the fuel pricing reform as of now, we have to do it right now, because I think 2 to 3 years down the line, given that fuel is a very low-hanging fruit for this for the center and the states in terms of the revenue mobilization, I think we have to move over to a regime of bringing it under GST. And the concept over here, just one lining, is that whenever you talk about this moving to GST, there's a discussion which says that what will be the revenue neutral rate. I think that's not the correct way of putting the thing. The correct way should be what will be the loss to the exchequer because of that one. So my sense is that inflation should remain a concern for us. And at some point of time, I would like to see that these inflation numbers trend forward, because on a sustained basis, 6% plus inflation in core inflation, and that too for an extended period of 12 months, may not be good for the economy and may not be good for the terms of trade movement against the rural sector.
So I think it was quite an interesting discussion, and I thought we could have gone on for another hour or so, but I think we need to end this. But in the end, I think to conclude, the few things which we took away was, we are talking about almost 10 years for this 5 trillion, and we need a double-digit growth rate. So on that note, we thank all of you for being a part of this event. Thanks a lot.
Thank you so much, sir.
Thank you.